Attention hard asset investors. If you want to maximize your gold and silver holdings, consider owning businesses that own a massive amount of the metal, who will benefit the most as the world witnesses the mother of all gold rallies. With nearly 10 million ounces of gold resources through acquisition, this 50-cent stock has received a $2.65 price target from Cantor Fitzgerald. Learn more at futuremoneytrends.com/gold 2016. Greetings and thank you for joining us at FutureMoneyTrends.com. I have the best possible person to talk to if you're looking at investing today, whether that is in a small cap stock, micro cap stock, resource sector, alternative energy sector. This is the one guy who has actually been right. You go over his track record on our interviews or the conferences he speaks at over the last 5-6 years. He's the one guy. He called the bull market and the rise in precious metals and the resource sector. But unlike every single person I've ever interviewed, in 2011, he gave a dark warning to resource investors, something that almost got him literally booed off stage at a conference where he literally told everybody, get ready, the deflation is coming. And that is exactly what happened. And he continues to be right with his calls. He continues to be one of the most sought after investors. Literally billionaires are chasing this guy down to invest with him. We are really privileged to be able to interview with him. I have become friends with this man, and he gets interview requests probably a dozen a day, and he does not do too many. So please listen to this entire interview. I've asked him to reveal at least one pick for us, as well as give us his information on what he's seeing around the world. He's also a New York Times bestselling author and hedge fund manager, Marin Katusa of Katusa Research. Marin, thank you for joining us.
Oh, it's a pleasure, Dan.
Marin, I want to get right into this and first talk about 2016. We are seeing some changes here. You know, since the fall, we've seen some of the gold mines rally significantly. Some of the bigger ones are up literally almost double. We're seeing a change in the way people view gold. It's back to being maybe not a change in the view, but maybe just more of an acknowledgement, I guess. What are your thoughts on 2016? Is this a turnaround for maybe not the resource sector, but for the gold sector?
Well, if you recall our last conversation, I said the two currencies you want to be in is U.S. dollar and gold. Here's my problem when you get into the equities, the actual miners, the explorers, the developers of the metal. In the first 55 days, okay, basically the month's not over yet, but let's say the first 2 months of 2016 has already raised more money in the gold sector than half of all of 2015. If you take the first 55 days of 2016, more money has been raised for the gold sector than the first 3 months of each of 2013 and 14. This is the hottest 55 days of money pouring into the gold sector ever. Okay. Now, what most people would sit there and go, wow, means it's a bull market. No, I'm telling you the exact opposite, Dan. What this actually means is the liquidity factor. What people have to understand is it's kind of like a Hotel California. You can check in. Buying into a private placement is easy, but the money coming in isn't money that has been around for a decade. Most fund managers who've been in this resource sector for the last decade have blown themselves up. They're down 80%. You know, I remember sitting on panels in 2012 and 13 and 14 with some of the most famous people in this business, and they're saying, geez, Marin, you're showing your age. You know, what do you mean it's not a bottom? I said, it's going lower. Well, guess what? You know, they kept buying there, and then it went down more and more and more, and they kept doubling down. So they don't have the capital to invest. But what the bankers are doing is, the reality here is that the currencies, the emerging markets have been so slaughtered, and their currency devaluation, that gold is a safe haven. It's an insurance policy. So that gives a base support for the stock. So you got these new money coming into the market, and they haven't quite figured out that, wait a second, when the gold does pull back, which I actually believe it will here in the near term, how do you get out of this? So these companies are increasing their market cap, but the liquidity isn't increasing and their share price isn't increasing. So there's a big difference there. I'm a big bull on gold. Don't get me wrong. People always say, geez, Marin's Dr. Doom. He's the most depressing guy on the street. Well, there's a reason why I run the largest fund here in the West Coast. So, look, be smart, pick right, sit tight, but be careful when gold's now a front page story. Step back, reanalyze, and think this through.
Now, for someone looking into the gold sector to make an investment in gold, you have been referred to as literally by a very legendary investor in the gold sector, Doug Casey. He referred to you as the most disciplined and best stock picker he's ever come across. And I remember that day I was actually sitting there with you and him talking about you, and he really gave it a lot of thought. And he was like, no, without a doubt, Marin is the best stock picker. For investors who do want to get into the gold equities because they have been smashed, what's either a pick you can give us, or how do you enter this gold sector right now before it starts to get into a massive upswing later on?
Well, that's a very generous comment from Doug. Doug is a living legend in our business. He's been a great mentor of mine. I've learned a lot from him, so that means a lot to me. Look, the number one thing, and this goes back to, the initial massive success Doug Casey had, and I spent a decade learning from him. People. It all starts with people, Dan. It doesn't matter in what business, in what sport, entertainment. You got to have that person, that it's like in a football. Who do you give the football to when you're on your last down, there's 3 seconds left? That's the guy you want to invest in, Mr. Clutch. So my first element I always look at is people. Then you got to obviously look at structure. What is the business plan? How are they going to execute the business plan? I'm a huge anti-debt guy in the resource sector. I also don't like streaming and royalty deals. That's a big no-no. Everybody loves streaming and royalty deals mathematically. And remember, I'm a mathematician from background. It is the worst. It's the death cross. It's the noose around an equity shareholder's neck. So I stay away from these things. Now, you find the right quarterback, and more importantly, he has to be fully invested. There's some simple rules here that I've laid out and talked about for years. If your quarterback, your president, your management, your insiders, if they're not the most invested people in the business, when things go awry, they're going to go look. It's just like fund managers. Over half of the hedge funds in the world, the managers don't even own their own stock. So when they blow it up, do you think they care? They want to hop onto a new trend. They're going to go raise some more money and move on. No, but when they own their own fund, like I'm the largest shareholder in my own fund, I'm heavily invested in it. I got to make sure that I have no choice for failure. That's the same thing with management teams in the resource sector. So look at insider buying. What percentage do they own? And are they buying every time I'm buying? And right now I'm putting millions into a company called Brazil Resources Inc., ticker symbols BRI. I am telling you that in 10 years, people are going to look back at Amir and say, wow, how did I not see this? This guy from 2011 to today, okay? People, I've been on your show. Go back a few years ago. I said, this guy's going to get to over 5 million ounces by 2015. I was wrong. He's at over 9 million ounces. But the key here, and what you got to understand is, look at the dilution. No other stock in the resource sector has gone to 0 to over 9 million ounces with as little dilution as Amir's done. Go compare it to every other that has had 200, 300, 400% dilution. Amir's been able to control his structure. He's been able to control his shares outstanding. There's no debt. And more importantly, they just announced their financing. If you look at how much money they've raised, they're not paying 10% finder's fees to these bankers and begging everyone to finance it. They had so much money allocated to them, they paid less than 2%. I think it was even less than 1.5%. There is not a single company on the stock exchange that has paid less finder fees to the bankers. People from the industry are coming and investing, and there's no finder's fees being paid. It's those little elements, it's those little variables that differentiate the guys who are going to be the winners of the Super Bowl and the runners-up. So that right now is if you were to say, Marin, what are you buying right now? Well, you'll see it. I'm buying a lot of that right now.
Marin, do you use Brazil Resources, or is it a gold optionality play? I know Rick Rule's been really talking this up lately. Or is this an ultimate gold producer?
Well, you see, I'm going to add something to what Rick's been a great friend of mine. He still is. You can't have a great optionality of gold without that optionality of eventually being able to be a producer. So if a project will never be in production, what is your optionality? Nil. So you look at the São Jorge project. That is economic at today's gold prices. It has over a $200 million MPV at today's gold price. That is a massive success at today's gold price. So with what BRI has is not just optionality to a massive increase in gold price, which I think we'll see, but the biggest upside here, in my opinion, is the free option, the optionality of one of the most strategic land packages and partnerships with Areva, which is France's largest uranium company, in the Athabasca Basin, which is the highest grade in the world. So you've got optionality to gold. You got optionality to economic production today. And more importantly, I'm very bullish on uranium here. So those are my two favorite mining, when people go, what are your favorite sectors to be in right now? Gold and uranium, I'm very bullish on.
It's interesting, because Brazil Resources, it is no doubt a gold company. Like you said, 0 to 9 million ounces of gold since it started. But it does have that uranium optionality play as well. Well, Marin, let's move on to the oil sector, because I know this is actually, you had a special energy letter when you worked with Casey Research. You're now writing at KATUSAresearch.com. Everybody can go there. They can subscribe free. They get to see the same information that you're sharing with the hedge fund managers and the billionaires that follow your work and that want to invest with you. So on oil, is this last year we talked when it first just started to make its way down, and you told me, Dan, just take your time. This is going to be a long time to play out. What are your current thoughts on the oil price and how it's
same thing?
Go ahead.
Same thing. You wouldn't believe the amount of media requests, because I've been one of the few guys early on when it first collapsed in Thanksgiving of 2014. And I said, no, this is not a V-shaped recovery. This is going to be lower for longer. I published that before Goldman Sachs did it. And if you look at what I talked about, the innovation in the sector, I've debated some of the biggest players in the industry. This is videotaped on the web in 2014. And I said, watch the prices, the cost of production going down. And then in 2014, everyone's up, but look at the drill rigs. I said, that's irrelevant. It's like talking about having computer servers in 2005 versus a computer server today. They're cheaper and more powerful today. So ignore the Generation 1 and 2 rigs. Focus on Generation 4 rigs. That's exactly what's happened. Bloomberg today came out with the Baker Hughes drill rig count is irrelevant. Geez, really? If you had a grade 6 understanding of the oil patch, you would have known that 2 years ago. So my point here is that we are in a new market. It's all about it's a supply and demand issue. For 2 years, everyone's been saying OPEC's going to cut back. I published, if you go on my Twitter account, I published my favorite spaghetti westerns, the good, the bad, and the ugly. And I said, here's the good, the bad, and the ugly. You got the North American shale sector, you got OPEC, and you got the Russians. And the reality here is that why would OPEC cut production? That would only prop up the Russians and the shale sector. Well, everyone said, well, the shale sector debt's going to kill them. I said, no, it's not. Why? Because what banker in their right mind wants to go get dirty and actually operate an oil field? So the debt would be amended, extended, and then you pretend. It's a classic amend, extend, and pretend. I talked about that a year ago. Well, we see exactly what's going on, because you can't just shut down an oil field. You have to reclaim those wells, which means you got to shut them down, environmentally reclaim them, and it costs more than that to do that today than what the actual value is. So the bankers know that, and the Russians. I said this 2 years ago on CNN during my big book tour, and they're saying, well, Russia is going to be done, their production is going to drop in half, their currency's dead. I go, well, that's the whole point. If you understand production, their production is in Russia, their currency's dropped by half, therefore their cost of production is half, and they're selling in euros, in yuan, and in US dollars. So that keeps a competitive advantage. So with innovation, the Western world costs will decrease, and the bankers have no choice but to amend, extend, and pretend the debt. So they're going to go lower for longer. The Russians have the advantage of pre-existing infrastructure and a devaluing currency. And then in the OPEC, let's not forget Saudi Arabia, Kuwait. This is the lowest cost quartile of production on the planet. When I was in Kuwait, we went to oil wells that have paybacks at $40 oil in 2 weeks. Wow. Do you think they're concerned? Yeah, of course they don't like oil at $20 because of their sovereign wealth budgets, but the reality is they can survive at $20 oil.
Do you think this is going to push the U.S. into an official recession? Because all the good jobs, if you look at it since 2009, they came from Texas, they came from Oklahoma, they came from Wyoming.
I've got a different perspective on that. There's no doubt that in the Bakken, in the Eagle Ford, you had massive high-paying jobs. But it's going to change. Like, for example, in Canada, the province that benefited the most from high oil was called Alberta. It's Cowtown. It's all the cowboys. And in the last 12 months, they've had 70,000 layoffs of jobs paying over $100,000 a year. And I would joke that these are roughnecks, and I wrote an article when I was at Casey about 2.5 years ago that when I'd go to these oil towns, you sit down at the casinos with them, and these guys were all about the hookers and blow. They're all about their toys, big fancy trucks, snowmobiles, and they're in the field for 2 weeks. They make $20,000 and they blow it all at the casino. And I'd sit at these tables, and it was like stealing money from a kid, candy from a child. And you knew it couldn't last. And what is happening then, the reality here is that these high-paying jobs are changing. For example, in California, when you look at the solar sector, those are high-paying jobs, and it's the largest growth in California in job growth of high-paying jobs. So the economy's changing, and I think there's two things here. In a zero-interest rate policy world, people have to rethink their investments. You're looking at higher volatility, lower returns, but much higher risk. But then I believe that with all this going on in the world, there's only two things that can happen. We continue with negative interest rates, which I see the trend globally. 35% of the Eurozone countries have zero interest rate policy, the negative interest rate policies, that's below zero. Mm-hmm. A third of the euro. The other 2/3, do you want to put money in Croatia or Greece? Hell no. So they're just a basket case to begin with. So by default, they can't even do negative interest rates. But there's going to be quantitative easing for the people. QE4P. And that's the reality here. Negative interest rates are about tax on wealth, tax on savers. But the reality is most of the people listening to your show are the smart people who contribute to society. They're the ones that have created wealth. They're the ones who are going to be subsidizing everyone else. So there's a great way to make money on this if you get ahead of QE4P, the quantitative easing for the people, and gold is one of those ways to do that.
Yeah, looking at the currencies, the devaluation, China and Syria. There's so many hot spots right now with the currency wars and the potential for actual war. Let's close off with your New York Times best-selling author on basically a book that was about Putin, the Putinization of resources. And I know you are working on a second book. And again, everybody should go to katusaresearch.com. You can subscribe for free. When you're looking out at Putin right now, and again, I should let the audience know you've traveled to over 100 countries. I think the last time we spoke, you had traveled to like 4 or 5 countries in the matter of 10 days, maybe more. But when you're looking at the world right now, what are some things in 2016 that, because you're so good at this, some things that people aren't thinking of that could happen or could likely happen?
Sure. Unfortunately, I'm addicted to the road, but there's a lot of sacrifices that you have to pay for the road, but it's what gives me my advantage in seeing the trends ahead of the trend. In investing, especially in speculation, you have to be ahead of the trend. And I believe that a lot of people are focusing on China, that they're going to collapse, and the shadow banking and all the risks. And those are all true, but those are obvious risks. What people aren't understanding is, what do you think the Chinese government is going to do? Allow the speculators to, short the market so that you could in a free market? People forget that China is a communist country, and they can change the rules as they please. And I'm shocked here in the West. I wrote a great article back in May about the China markets, and be very careful that nobody's talking about it. And I've got an interesting perspective on that, because Vancouver is kind of a hub for the Asian money. It's kind of like the Switzerland 20 years ago for North American tax dodgers. That's what Vancouver is today. And I know some of the wealthiest Chinese in Vancouver, and I've been sharing my research with them, and they completely agree that be very careful. And that's why so much money is coming out of China, but that's going to stop. Now, what do I mean by that? They're going to change the rules where they just have to keep the people busy. So when you look at aluminum production, they're going to subsidize the production regardless of the cost, and they're going to flood the global economy. That's a deflationary event. So what about steel? What about other products? When you're a communist country, eventually you have to go back to the communist principles of make sure that people do not revolt and keep the people fed. The money, that's secondary. Free market, not so much. So be very careful of certain metals. You won't see me ever talking about aluminum in this market. Iron ore, coal, dead. Waste money. I'd rather you go to casinos and get free booze and gamble in Vegas than speculate in the coal markets or the steel markets or the aluminum markets. Why? You want to avoid what China can flood the market. There used to be an old saying in our resource sector, buy what China needs. That was very famous. For 15 years, that's what everybody was talking about. I'm trying to adapt that and evolve it and avoid what China can subsidize and flood into the international markets. So that's one thing that I would really advise. And some of the smartest resource guys are jumping into coal, and I just don't get it. I've been saying for years, since 2011, stay the hell away from coal. And you look at Arch Coal, Peabody, we're talking about $80, $100 stocks to penny stocks. And the trend was so obvious, and they're going, but now it's so cheap. Well, it's a dead industry. There's so much coal out there that you don't need to invest in an industry that is shrinking, So that's the thing I'd stay away from. I think the European banks, if you look at the share prices of these things, they're dead ducks. There's going to have to become major subsidizing of the Euro banks. You look at Spain, the Italians, what a basket case that place is. The Greeks, what a failed state. Germany, Deutsche Bank. You look at all these factors, the derivatives on them. People don't understand the derivatives. I have a whole chapter in my book. Derivatives value is based on something else. And we're talking about value on steroids, speculation. So it's basically a quadrillion-dollar market that nobody truly understands or is regulated. So there's a lot of risks out there. But the risk that is going to take the market down is not what's being spoken about in the Wall Street Journal or in the blogs. It's things that people haven't even seen. And I think you'll see the European banks being a huge issue. I think the subsidization of countries and then tariffs will come in. So these are things to be very, very careful of.
Very interesting. Thank you so much for your time, Mr. Katusha. Again, everyone, KatushaResearch.com. People have paid tens of thousands, I think upwards of $30,000 for a specific newsletter at KC Research to peel into what Marin Katusha is investing in. He just gave us one of his top picks, something he's pouring millions of dollars into right now. And you can go to his site at KatushaResearch.com and get updates from him on the markets. This is an opportunity for everybody. This is the deal maker of Vancouver, and not only the resource sector, but many other investment opportunities. Marin is famous for his resource picks, but I have a feeling in 3 or 4 years he's going to be famous for another sector too. Marin, thank you so much for joining us.
Always a pleasure, Dan, and I hope your viewers are patient, and make sure you don't. One last thing I want to leave your viewers with is one thing. When you go and buy a stock, don't rush in. If you feel like you're missing the boat, stop. Take a second to think about it, but buy in tranches. If you have a $50,000 allocation to the sector, don't buy everything at one time. Ease into the position. Learn about it. Don't rush. We are nowhere near the bottom of the market, but if you pick right and sit tight, the companies that I'm investing in have to take advantage of what I see the value destruction. And the key line is buying tier one assets, significant resources at a significant discount to the replacement costs. By doing that, your margin of safety is so large that you will make so much money in this sector. And that's why we speculate in the resource sector. It is so cyclical. Make sure you take advantage of the cyclicality. So when everyone's buying all the majors because gold's up $50 in a few days, what do you think is going to happen when gold pulls back $75 in a few days? They rush for the exits because this is hot money coming into the big gold caps. Have to pay attention to liquidity. Focus on the simple principles of people invested in their own deals, going after tier one assets at a significant discount with a huge margin of safety. That's my business plan. That's what I'm doing. I don't buy many stocks, but I go very big in what I do.
Thank you, Marin.
Always a pleasure, Dan. Take care.